Understanding investments. This video explains key concepts to help you make informed investment decisions. Learn how to grow your money and build financial security through investing, whether you're buying government bonds from the Central Bank of Kenya or investing in Apple shares on the NYSE. What are investments? Investments are assets acquired with the expectation of increasing in value. They generate income or capital gains over time. For example, you might invest in Kenya Power stocks on the Nairobi Securities Exchange (NSE) or mutual funds offered by Vanguard. Investing means putting your money to work for you. Why invest? 1. Build wealth. Grow your money faster than inflation. In Kenya, inflation can erode cash savings, so investing in land near urban centers like Kitengela may outpace inflation. 2. Achieve financial goals. Fund retirement, education, or buying a home. Internationally, people invest in US 401k retirement accounts, while in Kenya, SACCOs are often used to save and invest toward building homes. 3. Generate income, earn dividends or interest payments. For instance, equity bank shares pay dividends, as do Coca-Cola shares globally. 4. Financial security. Create a financial cushion for the future. Key investment concepts. 1. Risk. The possibility of losing some or all of your investment. For example, investing in cryptocurrencies like Bitcoin can be risky due to price swings. 2. Return. The profit or loss generated by an investment, such as when a rental property in Nairobi appreciates in value or when Tesla shares rise in price. 3. Diversification. Spreading investments across different asset classes to reduce risk, such as combining Kenyan Treasury bills with international equity ETFs. 4. Asset allocation. Distributing your portfolio among stocks, bonds, and other assets to match your risk profile. Types of investments. Stocks. Stocks represent ownership in a company. They offer potential for high growth but come with higher risk. For example, buying shares in Safaricom offers the potential for strong returns in Kenya, just like buying Amazon stock internationally. Common stocks provide voting rights. Preferred stocks offer fixed dividends. Types of investments. Bonds. Bonds are loans made to companies or governments. They typically offer lower risk and returns compared to stocks. In Kenya, you can invest in Amakiba, a mobile-traded government bond, while globally, you might purchase U.S. Treasury bonds. Types include corporate bonds and municipal bonds. Types of investments. Mutual funds. Mutual funds pool money from many investors. They invest in a diversified mix of stocks, bonds, or other assets. In Kenya, CIC Asset Management offers mutual funds accessible to retail investors, while international investors use Fidelity or BlackRock funds. Managed professionally to spread risk. Types of investments. Exchange-traded funds, ETFs. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They often have lower fees than mutual funds. For example, an investor in Kenya can access global ETFs like SPDR S&P 500 ETF, SPY, through platforms such as the ABL Pension Fund, while U.S. investors use Robinhood or Vanguard to buy ETFs. Provide easy diversification. Types of investments. Real estate. Investing in property can generate rental income. Real estate may appreciate in value over time. In Kenya, buying plots in Ruiru or Juja for resale is common, while internationally, people invest in rental apartments in cities like London or Toronto. Requires significant capital and management. Types of investments. Other options. 1. Cryptocurrencies, digital currencies, highly volatile. Kenyans increasingly buy Bitcoin and Ethereum via platforms like Binance or Yellow Card, while international investors use Coinbase. 2. Commodities, raw materials like gold, often used as a hedge in Kenya and globally, and oil, often speculative. 3. Alternative investments, hedge funds and private equity, such as joining agribusiness investment groups in Kenya or venture capital in Silicon Valley, usually for accredited investors. Understanding risk and return. Higher potential returns generally come with higher risk. Matching your risk tolerance to your investments is essential. For example, a young investor in Kenya may take more risk by investing in tech startups, while a retiree in the UK may choose safer bonds. Balanced risk helps protect your portfolio during market changes. Diversification. Don't put all your eggs in one basket. Diversification spreads investments across various asset classes and sectors. For example, you might hold shares in KCB Group, land in Naivasha, and a US index fund. This reduces the impact of any single investment's poor performance. Helps balance risk and return over time. Getting started with investing. 1. Define your goals. Know what you want to achieve with investing, like paying school fees at Strathmore University or retiring at 60. 2. Assess your risk tolerance. Can you handle a market drop? Would losing money in foreign currency trading be too stressful? 3. Do your research. Learn about different investment options, including SACCOs like Styma Sacco or real estate crowdfunding platforms abroad. 4. Start small. Begin investing even with a modest amount, like KES 1000 in Amacuba, or $100 in a US robo-advisor. 5. Consider professional advice. A financial advisor or SACCO investment officer can help you choose wisely. Long-term perspective. Investing is a long-term commitment. Avoid reacting to short-term market ups and downs. For example, don't sell your cooperative bank shares during a temporary market dip, just as global investors are advised not to panic sell S&P 500 stocks during a recession. Keep your focus on your long-term financial goals. Thank you for watching. Remember, smart investing takes time, patience, and knowledge, whether you're building your Chama portfolio in Kenya or buying index funds in the US. Start today, stay consistent, and watch your financial future grow.